Hello everyone. Today we are going to discuss about goodwill. In this video lecture, we will talk about meaning of goodwill, features of goodwill, methods of valuation of goodwill, and some examples. Let's start with the meaning of goodwill. Goodwill is generally observed that despite of all things remaining same, those firms earn higher profit which has been in existence for number of years as compared to new firms. The reason is that over the period of time, the firm earns reputation due to which not only old customers but new customers join the firm. That is called goodwill. Features of goodwill are as follows. It is an intangible asset. The calculation of goodwill is difficult because it may fluctuate from day to day. It does not have any existence apart from business, so its value can be realized with the sale of business. Its value is dependent on the judgment of value. Now, let's move on to the methods of valuation of goodwill. First method is average profit method. In this method, the value of goodwill depends upon average expected profits and number of years. Average expected profits are calculated on the basis of past performance by adjusting future possibilities. So, the value of goodwill is equal to average profits multiplied by number of years purchase. For example, A and B are partners sharing profit and losses in the ratio 2:5. They admitted Y for 1/5 share. For the purpose of Y's admission, goodwill of firm will be valued on the basis of 2 years purchase. The profit of last 3 years were $1,20,000, $2,30,000 and $1,00,000. Calculate the value of goodwill. Now, we are supposed to calculate average profits of last 3 years, that is 1,20,000 plus 2,30,000 and 1 lakh divided by number of years, that is 3. So the total comes to be $4,50,000 divided by 3, which is equal to $1,50,000. Now, what is the value of goodwill? Value of goodwill is equal to average profits into number of years purchase. So the average profits are $1,50,000 and number of years purchase which is given in question is 2 years. $1,50,000 multiplied by 2, that is equal to $3 lakh. Second method is called super profit method. The excess profit made by a firm over normal profits is termed as super profits. Now, what are its steps to calculate the value of goodwill? First step is calculate average profits. Secondly, calculate normal profits by multiplying average capital employed with normal rate of return. And third step is determine super profits. Now, what is super profit? Super profit is equal to average profit minus normal profits. And lastly, goodwill is calculated by multiplying super profits with number of years. Let's have a look at an example. Profits earned by a partnership firm during last 3 years are as follows. In 2014, $15,000, 2015, $20,000, 2016, $25,000. The capital investment is $1 lakh. 15% is considered to be a normal rate of return on capital. Calculate the value of goodwill on the basis of 2 years purchase of average super profits. Now, what is total profit? Total profit is equal to 15,000 plus 20,000 plus $25,000. That is equal to $60,000. Now, what is normal profit? Normal profit is equal to average capital employed into normal rate of return. Now, as we know, average capital employed was given as 1 lakh in the question and normal rate of return is 15%. So, normal profit is equal to 1 lakh multiplied by 15 divided by 100, which is equal to $15,000. Moving on to the calculation of super profit, which is equal to average profit minus normal profit. Now, what is average profit? Average profit is 60,000 divided by 3, which is equal to 20,000, and we will subtract normal profits, which we calculated as $15,000. So, the super profit comes to be 20,000 minus $15,000, which is equal to $5,000. And the last one is value of goodwill. Now, value of goodwill is equal to super profit into number of years of purchase. So, which is equal to 5,000 into 2, which is equal to $10,000. So, at the end, the value of goodwill is $10,000. Next method is capitalization of super profit method. Goodwill under this method is ascertained by capitalizing the super profits on the basis of normal rate of return. Goodwill is equal to super profits divided by normal rate of return multiplied by 100. And next method is capitalization of average profit method. In order to calculate goodwill, firstly, we will calculate capital employed is equal to net assets, that is, assets minus liabilities. And we are supposed to calculate capitalized value of average profits, that is, average profit divided by normal rate of return multiplied by 100. So, the value of goodwill is equal to average profit divided by normal rate of return multiplied by 100 minus capital employed. And the last one is hidden goodwill. When the value of goodwill is not given, it has to be inferred on the basis of net worth of the firm. Now, what are its steps? Based on the new partner's capital, calculate total capital of the firm. Again, calculate combined capital of all the partners. And in the last step, calculate goodwill by deducting capital of all partners from firm's total capital. Let's have a look at the example. A and B are partners with capital contribution of $25,000 and $10,000. X brings $10,500 as his capital. The share of new partner is 1/5. Calculate the goodwill. Now, total capital is equal to partner's capital multiplied by its reverse of new partner's share. That is, his share is 1/5. So, reverse of 1/5 is 5/1. So, the total capital is equal to 10,500 multiplied by 5. So, it comes to be $52,500. Now, what is the combined capital? Combined capital is the capital contributed by A, B, and C and X. So, combined capital is equal to 25,000 plus 10,000 plus 10,500, which is equal to $45,500. So, the hidden goodwill is equal to total capital minus combined capital. Total capital is equal to 52,500 and we will subtract combined capital, which is equal to $45,500. So, hidden goodwill is equal to $7,000. Thank you.